Hello, and welcome to Repayment Strategies for Graduating Medical Students. My name is Jonathan Chancellor. I'm an Education Debt Management Specialist in the Office of Student Financial Services at the AAMC. When it comes to strategies for graduating students, there are a lot of questions that are on your mind. Are you going to be able to repay your loans during residency? How can you select the right repayment plan? Should you think about public service loan forgiveness? What about refinancing? What about consolidation? And also, how does new legislation affect you and your repayment strategies? In order to answer those questions and hopefully any others that you have, here's what we're going to touch on today. We're going to talk about a timeline for repayment. We're going to talk about where you can find those loans and what your options are for those loans. We're going to touch on what repayment plan options you have. We're going to go through some scenarios for repayment using our MedLoans organizer and calculator. We're also going to talk about the importance of budgeting in that student loan payment as a resident. And at the end, we're going to go through some additional resources we have available for you at the AAMC, and in particular, our first program. Let's start with a timeline for repayment. Right now, you need to be thinking about what loans do you have. In other words, putting together your loan portfolio. Are they federal loans? Are they non-federal loans? That's going to be really, really important because you're going to want to know, when do these payments begin? Before graduation, you're going to want to know, do you have to make payments right after? Is there a grace period? That's going to be very important for you when you're thinking about your financial goals. Upon graduation, that's when you want to start to think about the importance of or the options of consolidation or refinancing. You also even might want to think about forbearance. At the beginning of residency, that's when you want to ask yourself questions such as, am I going to pursue public service loan forgiveness? If so, you'll want to begin taking steps to submit all the necessary forms. 60 days before the end of a grace period or before your payments begin, you want to start exploring these repayment plans again. Not only just today, but again, looking at what those options are. Know if anything has changed. You want to do this so that you get your applications in and you're not delinquent on any possible repayment. A majority of you are going to go into what are called income-driven repayment plans, which means once a year on an annual basis, you're going to recertify your income. 60 days before that date comes up, you're going to want to once again look at the payment plans. Did something change? Is there a better payment plan option for me? So keep those things in mind and know what your repayment timeline is. We mentioned a grace period. Now, what is that? A grace period is a period of time after graduation in which you are not required to make a payment. This is something that comes with all of your federal direct loans. These are loans you see here, subsidized, unsubsidized, plus, and Perkins. After graduation, you have 6 to 9 months, depending on the loan, where you're not required to make a payment. Now, some of you might have taken a research year. Some of you might have taken a gap year. If that's the case, you may have used up your grace period. If you did, you're going to want to know what steps you need to take to either reapply or find out when that first payment's due. Now, where can you find your loans? This is a big part of putting that loan portfolio together. In order to find your loans, you need to ask yourself the question, what loans do I have? Are they federal loans? Now, most of you have a federal loan. This is a loan that comes from the Department of Education. We showed them just a moment ago, subsidized, unsubsidized, plus. Those are loans you could find going to studentaid.gov or looking on your servicer's website. Some of you might have had an institutional loan. This is a loan that's awarded and serviced by your school. How do you know if you had one? Where do you find it? Reach out to your financial aid team. They will tell you where that loan is, if you had one, and who is actually going to service that loan after you graduate. Some of you might have also had a private loan. These are loans that you would have gone out and applied for. It would be awarded and serviced by an outside financial institution. How do you know? One, ask your financial aid team. Two, look at your credit report. Any debt that you have, federal, institution, or private, will be reported on your credit report. Now is as good a time as any, as a graduating medical school student, to check your credit report, not only for private loans, but to just make sure that your credit report looks good, that there are no discrepancies, and there's nothing that you need to take care of at this particular moment. But that is where you can find the three types of loans you might have had. For your federal loans, this is the studentaid.gov website. This is the official website of the Department of Education. This is where you can find those direct loans. When you're on the landing page, you're going to view your loan information. Once you log in using your FSA ID and password, you can go to a dashboard. This dashboard is going to show you a number of different things about your loans. One, your loan balance. Two, who your servicer is, but also you're going to want to go to your loan details. As you're gathering your loan portfolio, you want to make sure that the numbers match with what you remember you took out. When you look at the details of your loans, you will see every loan you have ever had dispersed to you throughout your entire education career. What type of loan is it? How much was dispersed to you? What is the interest rate? What year did you take out the loan? And even how much interest has accrued on your loan. That is going to be something all of you should take time to do right now because this is the amount that the Department of Education says you are responsible for paying back. Make sure there's no discrepancies. Make sure the loans jive with the numbers that you recall taking out, and then you can move forward with selecting your payment plan. Remember something important about your federal direct loans. Interest rates are fixed. What that means is during the life of this loan, until it's either forgiven or you pay it off, the interest rates will not change on those direct loans. Now, in a moment, we're going to talk about consolidation and refinancing, and those are the only two ways that these interest rates might change. Other than that, these interest rates will stay the same no matter what we hear is going on with the economy, with interest rates in the housing market, or anything else. These interest rates are fixed for the life of the loan unless you consolidate or refinance. And we will touch on that in just a moment. Also, know the difference between a subsidized loan and an unsubsidized loan. When you're looking at the details of your loan and learning how much it is you're responsible to pay back, you're going to want to know the difference between these two loans. A subsidized loan is a loan that should not have accrued any interest while you've been in school. You can see those listed here on the left. An unsubsidized loan are loans that have accrued interest while you've been in school. So when you're looking at the details of your loans, you will see an amount of interest that's accrued on those loans. As a medical school student, during you medical school, you have been awarded unsub loan and plus loan, more than likely, through the direct lending program, because unfortunately there were no subsidized loans available for you unless you did the PCL or the LDS loans. Those are predominantly the types of loans you're going to see when you're looking at your details of your loans. Always remember something very important about that. Your loans are accruing interest. We're going to discuss a lot of different options for you moving forward, but always remember, even while you're in school, unsub loans and plus loans, they're accruing interest. Even if you choose to go into forbearance, which we'll talk about in a moment, loans are accruing interest. While you're in repayment, loans are accruing interest. This is not to scare you. This is just to remind you that any decision you make on what you're going to do with your loans moving forward, you're going to want to keep that in mind because the interest accrual could really affect what you want to do with your finances and your financial goals moving forward. Once you have all of your loans together, once you've completed that loan profile, that portfolio, we encourage all of you to put your loans in the MedLoans Organizer and Calculator. That's our MLOC. This is a tool that was developed specifically for medical school students. Once you put your loans in this calculator, and you can put them all in there, institutional loans, federal loans, private loans, that's when you can run scenarios based on your individual situation and learn what payment plans look like and which one's likely best for you. In a moment, I'll show you how this calculator works and show you how these scenarios are laid out. For those of you who don't know, this is a list of your servicers. Now, servicers are outside financial institutions that have been contracted by the Department of Education to service our loans. What that means is this is who you will make your payments to. Once you're in a payment plan, this is who will notify you when your payments are due, notify you when your payment is posted. They will notify you if there are changes to your loans. If you're not familiar who your servicer is, it is very important for you to do that. Okay, so just make sure that one of these servicers is in charge of your federal direct loans. Sub, unsub, plus, those are the ones that these institutions are going to be in charge of. Now, gonna stop, regroup, and think. I know you have a lot of questions right now, so start to write those down. Start to think about those questions. Once you have them written down, I encourage all of you to go back out to our new platform and register for one of the live webinars on repayment strategies or register for one of our AAMC office hours. That way, you have the opportunity to ask questions of someone on our team. Now let's move forward and talk about what options you have. When it comes to your student loans, you do have a number of options that you're going to want to think about. The biggest one is to pay or not to pay. Do you want to go into repayment as a resident or do you want to go into forbearance? What are the differences and what are the similarities? If you're in repayment, you're in a payment plan. You have a minimum monthly payment that you have to make in that particular payment plan. If you are in forbearance, you are not in repayment. That means you do not have a minimum monthly payment that you have to make. As a medical resident, you are in a program that the Department of Education says you can go into what's called a mandatory medical forbearance. So you're allowed to put your loans in that category. But guess what? Remember what we talked about earlier. Interest is accruing. Interest is accruing whether you're in repayment and it's accruing whether you're in forbearance. So we talked about earlier the importance of thinking about what your financial goals are. Your debt at the beginning versus end of forbearance or residency is going to be a lot different whether or not you're in repayment or forbearance. So think about what your goals are as a resident and whether or not forbearance is right for you or not. There are some similarities in these two options. One, you have to apply for both. If you want to go into repayment, you have to apply for a repayment plan. Remember back to the timeline we just discussed, giving yourself that 60-day buffer to choose your payment plan. You have to do that. Pick your payment plan, apply for the one you want. It's not automatic. Same thing with forbearance. If you decide you want to go into forbearance but not repayment, your servicer does not know that. Your servicer does not automatically assume you are in a residency, will automatically put you in forbearance. That's not the way it works. You have to apply for forbearance and be approved. Another similarity between these two options is that you can opt in or out of repayment or forbearance while you are a resident, and there's no penalty involved. If you're in repayment, you're struggling financially, you can apply for forbearance. The last thing you want to do is miss payments and go delinquent on your loans. If you decide to go into forbearance first, after a few months you think repayment is best, all you have to do is apply for a payment plan. And now you are in a repayment plan. So remember you have those options as a resident. A final note, when you are in forbearance, that does not count towards public service loan forgiveness. For those of you who think you want to go into PSLF, you have to be in a qualifying repayment plan in order for those months to count towards PSLF. Forbearance, you are not in a payment plan. You are not making payments, so it does not count towards PSLF. So make sure you keep that in mind. Another option for some of you would be consolidation. Now, what is consolidation? Consolidation is taking all of your federal direct loans. Let me repeat that. Your federal direct loans, sub, unsub, plus, Perkins, and putting them all into a single loan. That's what consolidation is. The way they create your interest rate is that they take a weighted average of all of the interest rates on your federal direct loans. Once they have that average, they will round it up to the next eighth of a tenth of a percent. You now have a brand new interest rate and one single loan. Remember earlier we talked about interest rates being fixed. This is one way that those interest rates will change. Now, once you have that interest rate on this consolidated loan, that particular interest rate is also fixed. Now, what are the reasons for consolidation? Let's look at those. One, do you have multiple servicers? Some of you might have been assigned multiple servicers for your federal direct loans. If that's the case, you might have more than one payment per month. If you don't like that scenario and you want to be under one single servicer with one monthly payment on your loans, the way you fix that is to consolidate your loans. Once you start that process, it will ask you to choose which servicer you would like to stick with. You consolidate, You have the one loan, and you're now under a single servicer. Another reason to possibly consolidate is if you have any loans that are not eligible for the income-driven plans we're about to look at, or if they're not eligible for PSLF. Now, how do you know that? All direct loans are eligible for public service loan forgiveness, and they're eligible for these income-driven plans we're about to look at. All direct loans. They are eligible for these plans and PSLF. If you had a loan that dispersed way back when, we're talking before 2013, 2014, that loan was called a FFEL loan. It's Federal Family Education Lending Program. That loan would not be eligible for PSLF or most of these IDR plans. Not likely, but if you are someone who had those loans, you would need to consolidate them into a direct loan in order to make them eligible for PSLF or most of these IDR plans. Now, how do you know if it's a direct loan or a FFEL loan? We talked about the importance of looking at the details of your loans on studentaid.gov. In the name of that loan, it will quite literally say direct unsub, direct sub, direct plus. If it says fell unsub or fell sub, those are loans that would need to be consolidated. So that's the second reason to consolidate. The third and final reason that many people would look to consolidate is if you want to begin your repayment right after graduation. We mentioned the grace period a moment ago. That is that 6 month period of time where you're not required to go into repayment. Some borrowers want to start repayment right away because they know as a resident you're getting smaller payments because it's based on your income, and they're likely going into public service loan forgiveness. So they want to have those things get started right away. The only way to opt out of your grace period is to consolidate your loans. If you don't, you are required to take that 6 month grace period. Now, a note about this process or this idea. You cannot consolidate until after you are graduated. The Department of Education will deny any consolidation application if you are still enrolled in school. So you cannot consolidate until after you have graduated. Number two, there is a processing time involved in the consolidation process. You have to submit the application. They will take them 30 to 45 days to process it. Once they do that, you have to pick a payment plan. It will take them another 30 to 45 days to process that. So think about whether or not it's worth it for you to get into these plans sooner and maybe get 2 to 3 months at max of additional payments, either towards PSLF or because you have a lower payment. But those are the main reasons to consolidate your loans. Another option for you is to refinance your loan. Now, what does refinancing mean? It's basically taking all of your loans, not just your federal direct loans like a consolidation, but it's, let's say you have direct loans, you have private loans, and you have institutional loans, or maybe you just have two of those types of loans, and you want to put them all into a single loan with a single monthly payment. What you could do is go out to an outside financial institution and apply for a loan that buys your loans from either the direct lending program, the institutional loan that you have, and you now have a single loan with an outside financial institution. That is refinancing. If you're thinking of doing that, ask yourself the right questions and always keep certain things in mind. Number one, will that new private loan have a variable interest rate? Again, I go back to the fixed interest rate option with your direct loans. A private loan might not have that. It might be a variable interest rate, so it might fluctuate up and down based on what's happening with the federal rates that we hear about in the news and in the economy. If you're thinking about PSLF, that's no longer an option. Private loans will not forgive your loans based on the PSLF program. Okay. You also just want to think about what are those new loan terms? What is the interest rate? How many years do I have to pay it off? What is the monthly payment? Those are the things that will be determined by this outside financial institution by looking at your financial profile. They're going to look at your debt to income ratio, your credit score, and your credit history. Based on all of that, they are going to offer you a brand new loan with all of those new loan terms in there. It's perfectly fine to explore this option, but before you sign on that line, make sure everything about that loan is exactly what you want. Make sure it fits in with your financial goals and what you plan to do moving forward with your student loan repayment strategy. We've mentioned PSLF a number of times, so let's just take a moment to make sure we all know exactly what that is. Public Service Loan Forgiveness is a program from the Department of Education that was put through in 2007, signed into law, where it states if you meet the four criteria you see here on this screen, once you've done so, the remaining balance on your federal direct loans, whether it's principal and or interest, is completely forgiven and it's completely tax-free. That is what PSLF is. It's a program that has been here for quite some time. It works, people get their loans forgiven, and it's something we encourage all of you to look into. The program itself has gone through a lot of great enhancements over the last 3 to 4 years. There's a new PSLF facts page, there's a dashboard, there's also an employer search. So the moment you get information about your match, where you're going to be doing your residency, you go out to the PSLF help tool, you put in the information requested of your new employer, and it will let you know if they are an eligible employer. So if you want to explore PSLF, going back to our timeline at the beginning of this talk, at the beginning of residency is when you would submit your form. It's all electronic, it's all online, and it's a very simple process. Once you're enrolled in the PSLF program and you enroll in an eligible repayment plan, you're going to have a dashboard that shows you a number of different things. It will show you details of all of your loans, your payment history. It'll show you employment certification once that gets improved. And you also see a dashboard that shows you where you are in the progress of getting your loans forgiven. In this particular example, 116 qualifying payments out of 120 have been made. So this borrower knows I've got four more payments until my loans are forgiven. So it's a great, great dashboard. It gives you a lot of information and it keeps you updated where you are in the process. Other options to help you with your student loans that should absolutely not be overlooked would be these you see here. If anyone plans to serve in the military, practically every branch of the armed forces has some sort of assistance they will offer you to help you either pay on your student loans or give you loan forgiveness. There's also assistance through National Health Service Corps and NIH. We encourage you to look at all of these. This is an actual resource we have for you at the AAMC First program. You click on each of these icons and it will show you more detailed information on those forgiveness provisions. So take advantage of those, especially if you plan to serve in the armed forces. Now, I'm sure we have gathered a lot more questions, right? Now, hopefully, we're answering your questions, but we're throwing a lot of information at you. So please add to your notes, add to the possible questions you have, and make sure after this video you go out and register for some AAMC office hours or one of the live repayment strategies webinars where we can also answer questions for you there. Now let's talk about those repayment plans. That's something that a lot of us are probably ready to dive into. We've gathered our loan portfolio. We know what our timeline is. We know what our options with our loans are. But let's look at what those repayment plans actually are. As you begin to prepare for repayment, make sure you're taking the proper steps. Make sure you've updated your contact information with your servicer and the Department of Education. So if there's any changes and they need to reach out to you, they can do so. Make sure you're exploring these plans. We're doing that now. This video is going to be available for you all the way through the end of May. So keep exploring, keep learning about IDR plans. Know if an auto enroll or auto pay is something that you want to do. And also make sure that once you're in this payment plan, you know you've got to make your payment. That's going to be really important for all of you. So these are just a few ideas of some steps you want to take to prepare for repayment. One of those, of course, is learning what these payment plans are. When you're looking at your options, you're going to have two buckets. You're going to have traditional plans and you're going to have income-driven plans. Traditional plans are going to have a monthly payment based on the level of debt you have when you enter repayment. These plans do not look at your income. They only look at how much money do you owe? What is your debt at the time you enter repayment? That's one bucket. Medical school students going into residency tend to veer to the right. You go into income-driven plans because these plans do not look at your level of debt. Instead, they look at your income. As a resident living on a stipend, we're not making that attending physician salary just yet. So sometimes living on a stipend can be a little bit of a struggle. So most of us are going to go into an income-driven plan. They are going to base your monthly payment on a percentage of your income. That seems much more desirable for residents who are living on a stipend. Now, let's break those options for you down right now. As of this moment, these are the income driven plans that are available to you. You see a list of all of them here. This chart offers you a way of looking at what are the similarities and what are the differences. Things that we like to highlight is that there are a lot of similarities in these plans. They all give you up to 20 to 30 years to pay off your loans if you need it. They all give you a percentage of your income that they're going to ask you for based on that income. They're all eligible for PSLF. I hope we all see that. They all also have a very same plan when it comes to if you're married. This is a very common question. All of these plans have the rule such as this. If you are married and you file taxes jointly, your spouse's income is going to count towards the calculation of your minimum monthly payment. If you are married and file taxes separately, your spouse's income will not count towards that monthly payment calculation. Now, even though that is the rule for these student loans and that payment calculation, that is not anyone at the AAMC telling you how to file your taxes. Keep that in mind. Please make sure you discuss that with someone who you know. If you know someone who's a CPA, an accountant, someone who can give these numbers to you, that's going to be really important for you moving forward. So make sure you know that. Also, last big note, these are the plans available to you as of this moment. Okay. These plans can and do change due to different legislation that could be coming forth or has already been passed. So we go back to the importance of looking at payment plan options, reviewing what those are, and seeing which is going to be best for you moving forward. Now, here's an idea of the new standard repayment plan that just came into law signed by the president on July 4th of 2025. This is the new standard repayment plan. It is a traditional plan. It is not based on your income. It's only based on how much you actually owe. As you can see here, most medical school students are going to graduate with more than $100,000 in debt. So therefore, they're going to put your payment plan on a 25-year payment plan. They're going to give you a single monthly payment. You will make that same payment for 25 years. Again, not usually what a resident is going to want to go into. The new repayment assistance plan, this is the RAP plan. This is how we're breaking the breakdown is of those monthly payments. And we wanted to give all of you an access to how this is looked at. Based on your income, they're going to ask for a percentage of your adjusted gross income and divide that by 12. So you could see here how that's going to look. Now, once you know where you're matched, where your residency is, you're going to get information on what your income is. You're going to use this chart to determine ballpark, what is my monthly payment range going to look like? So we just wanted to make sure to show that to all of you. Remind you that typically speaking, you're looking at a salary range of about $60,000 to $70,000. So just wanted to break down the new RAP plan for you a little bit more in detail because that is a new plan that will take effect on July 1 of 2026. So let's show you a repayment scenario. And the way that we're doing this repayment scenario is we're using our MedLoans organizer and calculator that I touched on just a moment ago. So we want to give you an idea of how that works, the types of information it needs, and how it's going to lay out your options for you. So let's just say this is an example of one of you watching this video. You're going into primary care. You have a residency of 3 years. You have a student loan debt of about $215,000. We're looking at a starting residency stipend of about $69,000, and you're going to want to project what it is that you feel your particular specialty is going to offer you when you start as an attending physician. These are the types of numbers that the calculator is going to want to ask of you. So it's also going to ask you how many people in your household. It's going to ask you if you want to go into PSLF. It's going to ask you a lot of different things. But this is the core data that the MLOC is going to ask of you. When you put in that data and then you ask it to run some numbers, this is an example of how it lays out all of that information for you. It's going to show you all of the repayment plans that you're eligible for. It's going to show you how long it will take you to pay off your loans if you stay in that repayment plan and make only the minimum monthly payment required every month. It's going to show you how much your payments are as a resident, how much your payments are as an attending physician, and it's also going to show you how much you pay on that loan for the life of that loan. Again, pretending or figuring that you stay in that plan for the full 20, 21, 25 years. Okay. The other thing the calculator shows you is if there's any amount forgiven due to forgiveness provisions in those payment plans. So we all see here a 201,000 forgiven in the income-based repayment plan. This is not PSLF. The calculator will show you PSLF numbers, but this is not PSLF. These repayment plans come with a forgiveness provision that says as long as you pay on your loans for the full years we're allowing, in this particular situation, IBR gives you up to 20 years, but it's based on income. And since your income didn't get high enough for those payments to go high enough, you actually over 20 years paid 390,000, but there was still 201,000 left. So that's forgiven. However, again, that is not PSLF. That means you have to pay taxes on that particular amount. That is not PSLF. It is a forgiveness provision. The calculator will show you all of that. It will break it down for you and show you what is forgiven through forgiveness provisions, what will be forgiven through PSLF. You will be able to see all of that. And in that way, looking at these numbers, you will make that determination on what payment plan is going to be best for you. As I mentioned a minute ago, you can also think about numbers if you do PSLF. So in this particular chart, you'll notice we wanted to show you the difference between the new RAP plan and the current IBR plan that is in place. Now, the monthly payments are pretty similar, and we figured they were gonna be because they're based on a particular percentage of your income. You have the same amount of residency, same amount of attending physician years, 10 years, 120 payments. But you can actually see which one you pay less on over this period of time. And in this particular case, and this is just in this particular case, the income-based repayment plan is actually a little bit better for you. So no one size fits all. That is what we want you to take away from this scenario. Not all of you are going into primary care with a 3-year residency, with a $215,000 debt, a $69,000 stipend. Everybody's going to have your own numbers. That is what we encourage all of you to do. Use this MedLoans organizer and calculator, put in your particular numbers, and see which plan is going to be best for you. Now, we showed you a minute ago also how all of these income-driven plans, they have a long time to pay off, 20, 25, 30 years. But the AAMC has recently put together some data where we have actually asked physicians, how long did it take you to pay off your loans? What we're seeing is a lot of physicians end up being more aggressive with their student loans after they become an attending. They're making better money. They decide they don't want to wait for 20 years. They don't want to wait for 25 years. So they get more aggressive with their loans. In this snapshot here, you could see that no specialty group took more than 8.3 years to pay off their loans. So that's why when we show you all of those big numbers we just did, that's if you stay in those income-driven plans, make the minimum monthly payment every single month, and are not more aggressive. But based on this data that we've collected, it looks like physicians tend to be more aggressive and pay off their loans sooner. So just also keep that in mind when you're thinking about what you want to do with your student loans. That more than likely raised a few more questions. I hope it also answered a lot of your questions. But once again, after this video is over, register for some live webinars so we can help answer even more, and also register for AAMC office hours. Go out there and do that so that we can sit down and have a conversation with you about any questions that you may have. Now let's talk about budgeting in this payment as a resident. First things first, you got to break down your month. Now, your month, of course, is based on what your projected stipend is going to be. We know that the amount of your stipend isn't what you get to take home. We know that. There's a lot of things that comes out of our paycheck, our taxes, our health insurance. We know that. Once you get that take home, when that net income, that's when you want to start to break down your month. Know which of these things might change and which ones might not. Rent, going to stay the same for probably about a year. Health insurance, car payment. Those things don't really fluctuate as much. Start to put together a budget. Break down your month. One resource you have available for you is a budget worksheet for residents that was created at the AAMC. You could go out to our website, you can download this document as a PDF, you can fill in the blanks as you spend, or you can even use this as a resource. Use it as a way to look back and think, did I put in everything I needed to put in? Did I put in all my monies for utilities? Did I put all my monies for parking? Did I put in all of my expenses that I know I had over this particular month, week, semester, however you want to break it down? Take advantage of this tool. Another thing to do, put it in writing somewhere, even if it's something as simple as an Excel sheet. If you have a budget in writing, it forces you to keep accurate financial records. It forces you to review your bank and credit card statements often. That is only going to help you with your financial goals moving forward. An Excel sheet like this shows you your total spend, your average spend, highlight where you overspent. Think about, why did I spend a little bit more this particular time? Why did I spend a little bit less in this particular moment? That's going to be very, very important for you when you put in all of these different bills and expenses that are going to come at you. You got to pay your rent. You got to pay your utilities. You got to pay your student loan payment. You got to make your car payment. These are all, not for all of you, but for a lot of you, going to be brand new responsibilities and expenses. So please put a budget in writing. Also, always remember that many of you, even at this moment, are going through a lot of wonderful, wonderful changes, right? You're going to experience changes in your income, going from a med student to a resident to an attending physician. You're going to likely experience changes to your marital status. That might also, in turn, change the number of dependents that you have. That's going to change a lot of things for you, but it's also going to really change what your financial goals are going to be. Now, it might not just be for you, it might be for your family. When you change those financial goals, when you change that marital status, that number of dependents, guess what? It changes your student loan options. You might get a lower monthly payment. You might have a higher monthly payment. You might have different payment plan options available to you based on those changes in income, based on that change in dependence. You always want to remember that. Anytime big changes in your life happen, which all of you are about to experience, and they're going to be wonderful, explore your repayment plan options. You can always do that. You can always go out there and do that. Just because you go into a repayment plan at the beginning of residency does not mean you have to stay in that payment plan for the life of the loan. Remember that. Explore your options. These changes are going to be wonderful, and they're also going to offer you different options with your student loans. Let's look at some additional resources created for you at the WMC and the FIRST program. So first, this is the landing page for our FIRST program. FIRST stands for Financial Information Resources, Services, and Tools. The first thing I will say about this program is it is completely free. There is nothing on this program's website or in this program that is hidden behind a paywall. You all have access to guides, fact sheets, webinars, resources, the calculator. All of this is available to all of you, and it's all completely free. Please take advantage of it. The first thing to highlight would be our Guide to Money Management and Student Loans. This is a comprehensive guide that has together all of the different resources available for you at the AAMC First program, and also throughout the entire guide links to the studentaid.gov website. You'll notice that it is broken down based on where you are in your education career. If you go to the graduating med school section, you're going to see information that's more involved in student loan repayment, budgeting as a resident. It's going to break all of that down for you. Once you become a resident, you're going to see a lot of other things, talking about grace periods, talking about more about budgeting, putting that student loan repayment in, talking about living on a stipend. So it's still going to be there for you after graduation. All of you are preparing now. You're still a med student, but eventually you will be a resident. These resources are still there. This is a brochure that all of you can also download off of our website, put it on your desktop. You will see that it is a different way of looking at your timeline of responsibilities. What do you need to be doing before graduation? After graduation, what you need to be doing annually, what you need to be doing every 6 months. You will also notice there are hyperlinks if you want to know more about deferment or forbearance, income-driven plans, PSLF. That is all there for you. Create a folder. Put all of these resources in it on your desktop so that you can access it easily and make sure you're utilizing it. There's also a card called our tips during residency. We've broken it down for you in different sections. We've talked a lot about student loans today, what your responsibilities are, what you need to be doing. There's also an entire side devoted to managing your money, developing that spending plan. We barely touched on budgeting, but there's more information there. Checking your credit reports. That is huge. I touched on that a little bit when we talked about looking at private loans, but you need to know that your credit score and your credit report is good, that it's sufficient because you're about to apply for a lot of things for the first time. Knowing about whether or not you're properly insured, different types of insurance, thinking about investments, retirement. Residency is not too early to start thinking about those things. We give you a lot of great advice, tools, and links here that can help you start thinking about all of these things now. And I promise you, when you get out of residency, knowing you've had 3 to 4 to 5 years of putting into a retirement plan, having a Roth IRA, you're going to be very grateful that you took the time to do that. Also, our financial wellness program. This is something all of you have access to now. You can complete online courses where you can measure your financial health. You can get personalized recommendations. You can assess your risk of identity theft. A lot of things in this program we know as a medical school student, you are finishing up one of the most demanding curriculums on the planet. Now, if you haven't done so previously, focus on your financial wellness. Utilize different things in this program. There's even a tracking and spending tool. So for those of you who want to put a budget together for the first time, do it. You can do that here. Take advantage of a program like this. Also, we have a first videos and webinar series. You could see here all of the different types of topics that we cover throughout the year. If we've already had the webinar, they're live webinars, we post the video on our website. You are going to be given access, as you are now, to all of these different webinars. So take advantage of those. There are still some coming up throughout the entire months of February, March, April, and May. Register for them. If we've already hosted one that you're interested in, you can watch it now. We link you to a YouTube page where you can watch those webinars. So go out there and take advantage of those as well. They're about an hour long, and you have access to them all day and night. So we want to thank you so very much for being a part of this video. If you have any questions for us at the first program, please contact us first at aamc.org. This QR code is something all of you will use when you watch our first webinars. When you go to one of the live webinars, it will just ask you to basically let us know which session you attended so that you can let us know where we can improve, where we can be better, and what more we can offer you throughout your repayment strategies journey. So want to thank you very, very much for being with us today. As I said, my name is Jonathan Chancellor. If you have any other questions, just let us know. Thank you and have a great day.